Good afternoon, everyone. Welcome to our Saturday webinar today. My name is Tiffany, and I'm the tax manager in the Community CPA. Today's section is focused on the qualified business income deduction, commonly known as QBI, and the recent legislative updates under the One Big Beautiful Bill Act, or OBBBA. These changes have long-term implications for business owners, especially those operating pass-through entities. We are proud to present this webinar through Community PA, your trusted partner in business accounting. Our mission is to empower entrepreneurs and the small business with the financial knowledge they need to thrive. You can find more resources, including books and videos, on our website and the YouTube channel. So this is a screenshot of our website, and then you'll be able to look for more details about our firm. So we have 4 office locations in US, and we have more than 12,000 clients, and we provide business tax filing, personal tax filing, sales tax filing, payroll accounting, and then we also do audit. So if you want to know more about our company, please check it out. And this is our YouTube channel screenshot. Every Saturday, Wednesday, and Tuesday, we always have YouTube videos posted in Spanish, in Chinese, and in English. If you haven't followed our Community CPA YouTube channel, please subscribe so that way you will receive most updated information from us. And this is our CEO's. She already published 2 books. One is Appointment with Yin at 8 a.m. and the second one is Appointment with Yin at 10 a.m. They have a different focus because the AM is more focusing on how to start up their business, and the 10 a.m. is the one how to grow your business. And both books are available at Amazon, and we also have audiobook available as well. Please check it out. Okay, before we begin, please note that this presentation is for education purposes only. While we strive to provide accurate and timely information, tax laws are subject to change. We encourage you to consult a qualified tax advisor before making any decisions based on today's content. So we are doing our best to stay informed. The information could be changed. So we just want everyone, we want to share the most updated information, but everyone's situation is different, okay? If you would like us to help you, please reach out to us at our website. Okay, so let's start. Why the QBI deduction matters now more than ever. The QBI deduction allows eligible business owners to deduct up to 20% of their qualified business income. This can significantly reduce taxable income, especially for small and mid-sized businesses. The OBBBA has made this deduction permanent and introduced enhancements starting in 2026. Today, we will cover who qualifies, how is calculated, what is new, and how to optimize your tax strategy. And based on the slide, you can see that with all the changes, and then you will definitely benefit lots of the small and to medium-sized business owners and the taxpayers. QBI is the net income from a qualified U.S. trailer business, and the eligible taxpayers, including sole proprietors and owners of pass-through entities like partnerships, S corporations, and LLCs. And the C corporations are excluded because they are taxed differently, because C corps is like a 1040s. They tax at their own entity level. Okay, and then the deduction also applies to 20% of qualified REIT dividends. So the REIT is the abbreviation for Qualified Real Estate Investment Trust. And the first time the QBI was introduced back in from the Tax Drop Act back in 2017, and now they are making this big change after OBBBA. So how the OBI calculate, how does a QBI going to calculate? So QBI includes ordinary income from business operations, rental income if it qualifies, and the income from public traded partnerships. It excludes capital gains, dividends, interest income unless it was properly allocable to the business, wages paid to the taxpayer, and the guarantee payments to partners. There are also more information that you can check it out at the IRS website that is going to exclude from the QBI calculations. But most importantly, QBI is calculated per business, not in aggregate. So that does mean that if you have multiple business and each business there is qualified for QBI calculation, and then each business will have its own QBI deductions. Okay, next, how income affects your QBI deductions. So in 2025, the deduction begins to phase out at $197,300 for single filers and $394,600 for joint filers. It's fully phased out at $247,300 and $494,600 respectively. For high income taxpayers, two formulas apply to the threshold, and one is 50% of the W-2 wages paid by the business, or 25% of the W-2 wages plus 2.5% of the qualified properties. So its original cost not reduced by the depreciation. So these rules make payroll and asset decisions critical to maintain eligibility. So what kind of business will be qualified for QBI? So this is the rule that we're going to talk about, the special rules for specified services, trade, or business. We normally call this SSTB. So SSTBs are business where the principal asset is the skill or reputation of the owner or employees. Examples include health, law, consulting, performing arts, athletics, financial services, investment management. Engineering and architecture are notable excluded, SSTBs face strict limitations under the QBI rules. SSTB impact on QBI deductions. And if taxable income exceeds the threshold, the QBI deduction is reduced for SSTB's business, and is completely phased out once the income exceeds the upper limit of their phasing ranges. And that means for higher income professionals in these fields may lose the deduction entirely. So strategic planning such as restructuring or your income splitting can help preserve the benefits. So, like I mentioned earlier, the QBI deduction now is permanent after the OBBBA. Originally, it was set to expire at the end of 2025. Now the OBA deduction is permanent because of the OBBBA. So this provides long-term certainty for business owners and the tax planners. So it also reduces the need for short-term tax strategies and allow for more flexible and multiple years strategies. So it's a good news for small and the medium-sized business owners. Okay. And also, the OBBBA also expanded the phase-in ranges. So starting in 2026, the phase-in range expands to $75,000 for single filers and $150,000 for joint filers. So this means more taxpayers will retain partial or full deductions even as the income rises. The deduction will phase out more gradually, reducing the cliff effect. This threshold will also be adjusted annually for inflations. So it means that it will bring greater flexibility in income planning, especially for high earning professionals and business owners near the threshold. A boost for smaller business, yes, because they also have this new minimum deductions. Beginning in 2026, a new 400 minimum QBI deduction will be available for taxpayers who materially participate in an active trade or business and have at least $1,000 in QBI. So this ensures that even lower income business owners receive a benefit, and the minimum will be adjusted annually for inflations. So it provides a baseline deduction for small business owners who might otherwise receive a little or no QBI benefits, and encourage continued participation in active business operation. So the strategic move to maximize your QBI deductions. To make the most of the QBI deduction, first of all, you need to reevaluate your entity structures. Consider whether your current business form, whether your sole proprietorship, partnership, S corp is optimal under the new QBI rules. The C corporations are not eligible. Pass-through entities may offer better tax outcomes, but again, it's going to affect on your personal, because all the ones that qualify for QBI, they are pass-through entities. So we need to measure on your business and also your personal together to see which one will be the best tax outcome for you. And the next one is managed taxable income. Keep income within the threshold ranges to preserve full or partial deductions, and use retirement contributions, accelerate expenses such as the bonus depreciation they bring out from the OBBA or the income deferral strategies. And then the next one, optimize W-2 wages and property ownership. So for high-income taxpayers, increasing W-2 wages or investing in qualified property can help maintain eligibility, and review payroll practices and asset acquisition timing. And next, special considerations for SSTBs. So explore restructuring your options to separate the non-SSTB activities, and then consider income splitting or family employment strategies. And next one is leverage the new minimum deduction. That's the one that happened after 2026. So ensure material participation in active businesses and track QBI carefully to qualify for the 400 minimum deduction. The action step for us. So if you have any questions on this, make sure that you consult to a qualified tax advisor to tailor the strategies to your specific situation and take full advantage of OBBBA enhancements. So in 2 minutes, and what we need to do, what we need to remember about the QBI deduction and OBBBA. So basically, you need to remember the QBI deduction remains a major tax benefit because it can go up to 20% of deductions on qualified business income for eligible pass-through entities and the sole proprietors, and then it reduce your taxable income on your 1040s. Okay, and in because of the OBBBA, and then it make the QBI deduction to be permanent, so no longer set to expire after 2025. So we need to think about the long-term planning if it's possible, and it also expand the phase-in ranges starting in 2026. So more gradual phase-out means more taxpayers can qualify for partial or full deductions. Also, starting in 2026, there's the new minimum deduction for smaller business. So it's 400 minimum deduction for active participants with at least $1,000 in qualified business income. Okay, and next, high income and SSTB limitations still apply. So income thresholds and business types still affect eligibility. So planning is very important for all of us. And so need to revisit your entity structure, payroll, property investment, and the income timing can all impact your deductions. So make sure that you have a habit to have a tradition or a things routine to check on this with your tax advisor to make sure that the strategy have a tax planning for the year, so that way you will really understand how it's going to affect your business and your personal with this OBBBA. So next is going to be introducing our website. So if you are interested in getting a consultation or tax planning with us, and you always can come to our website and select a partner and book appointment with them. So we have Yin, which is our CEO and the managing partner in the firm, and we also have Dan. He is on the discovery consultation, client services, and the business formation. And then we have Derek. He is our IT department partners. And we have Dr. Hao. He is focusing on government audit, special programs, and the compliance audits and immigrant part. And we have Song. He is the tax and audit partner, and he's focusing on tax plan strategies, filing and audit, and the financial statement audit and attest. And then the last we have Huang. She is overseeing the accounting, payroll, and the sales tax in the firm. The last, and we want to bring out our YouTube channel to all of you. So if you are interested in our content and you want to hear more from us, and please subscribe our YouTube channel at Community CPA. And if you have anything specific you want to hear from us, feel free to email to Catherine@communitycpa.com. And if you are interested in working with us, or you want to know more about our firm, please feel free to call our phone number, which is 515-288 and 3188. And our office are open from Monday to Saturday from 8:30 to 5:30 p.m. Central Time. Okay. I think that's all. And thank you for your time to listen our webinar. And we'll see you guys next week. Thank you.